Hey, welcome to this episode of InvestU. Today we're going to be doing an analysis of the Netflix stock, which is traded on the NASDAQ as ticker NFLX. So let's get into some basic info about this stock. So as mentioned, the ticker is NFLX. It's traded on the NASDAQ. This analysis was performed on the 24th of April 2020. It presently has a market cap of $186 billion. The stock price is $422.94, and there are 439 million shares outstanding. So recapping our investing rules, as value investors, we're looking for PE ratio of less than 25, a market cap greater than 500 million, which this stock has, a current ratio greater than 1.5, a return on equity of greater than 5%, a debt to equity of less than 50%, consistent earning per share growth, 10 years of dividend payments, dividends greater than 2%, good intrinsic value, which is greater than the stock price, and we're in this for the long term. We're not looking for short-term gains. We want to find good companies that have good value. Okay, digging into some key metrics for the Netflix stock. So as mentioned, the price is $422.94 at the moment. The PE ratio is 78.25, which suggests that this is really overvalued. And the earnings per share is about $4.94, which returns about 1% relative to the stock price per year. Now, if you look at the Netflix stock, it has been booming lately, as we have seen through demand going up over coronavirus concerns and us hunkering down here. But at the end of the day, we do see that this is very overvalued. It does not have a dividend that it pays out on a consistent basis, and this is a tech stock, so we're not really surprised with this. Generally, with tech stocks, they reinvest their money back into the company and try to grow that way. It has a price to book of 22.7, which gives us a margin of safety of 4%, which suggests that it is, again, a very overvalued stock. The book value is not there to support the high price, and that's a major red flag for us. Debt to equity of 1.74, and we'll dig into why their debt is so high. A really good return on equity, though, of 14.9%, so quite an efficient company from a management point of view. Current ratio of 0.90, which, again, is lower than the 1.5 that we're looking for, so that's not good. EV over EBITDA of 13.5, and generally a pretty low correlation to the S&P 500, and that might be because of the takeoff we've had recently, where Netflix has been going up and the S&P 500 has been going down as people self-isolate. So with tech stocks that have high PE ratios and high price to book, one thing I like to look at is the outstanding shares. And what I'm looking for is really a high growth of this over time to see if they're diluting the shares, to see if that's how they're financing activities. So we do see some increase of shares consistently since about 2011, but it's not really drastically increasing that much year over year. A few million shares here and there. So it doesn't appear that they're solely financing their activities based on diluting the shares. So looking at the value over time, and again, this is from our ticker, feel free to send us an email at valueinvestu@gmail.com, and the email address will be posted in the show notes below. We see great revenue growth for this company and good net income growth. However, when you go down to debt in here, you'll see that the debt is growing tremendously over time. And that's largely because Netflix is trying to create content and buy content. So they are, and they do mention in their annual report that their debt levels are something that is significant. And as interest rates change, that can impact how they finance their activities and their ability to finance new shows and new content or buy licensing. Debt to equity ratio is very high. Current ratio is low. We do see, generally good earnings per share growth. There's a bit of fluctuation that is there, but at the end of the day, there's a lot of red flags from a value investing point of view with this stock. So if we do comparison to its peers, we see that relatively it does have positive earnings, which is good for an entertainment company. However, it does have a very high PE ratio when you compare it to others that also have positive earnings: Cinemax Holdings, Marcus Corporation, and Disney. Return on equity for the short term is fairly good amongst its peers. The price to book is very high, especially when you compare it with others that are producing content. Main company that I'm thinking of is Disney, and it's Disney Plus. The current ratio is again pretty low, but it's in line with its peers, and the debt to equity is also, I'd say, in line with its peers as well. If you take a look at the average, some of these companies have an incredibly high debt to equity ratio, but from an entertainment company perspective, I would imagine they're buying content, they're making content, they're investing a lot into these things, so it makes sense that overall they do have a high debt to equity ratio. So doing an intrinsic value here, so I looked at the net income and it's growing at roughly 27% over the long term. We're discounting this at 10% and using a growth rate in perpetuity of 2%. However, they do have a negative cash flow right now. So in using the last cash flow that's on their books for 2019, we arrive at an intrinsic value of negative 95.22. And I know that doesn't really make sense. I mean, at the end of the day, Netflix is making money, but they're spending more money than they have. So, how do we really evaluate this company? And the other way I looked at this was doing a simple book value growth approach, where we're looking at that book value growing over time, and it's a very similar rate. It's around 27%, and we keep a very similar price to book. That hasn't changed too much over the years. It has increased a little bit in the past. So if I use that, I arrive at a share price of $643.92. So when I look at this, I say, this is a huge difference. If I use the intrinsic value discounted cash flow approach, I result in a negative number. And if I use the book value growth approach, I result in a very high positive number, higher than what we're seeing the share price trade at right now. And I think this just speaks to the potential volatility of Netflix. It could have a pretty significant upside, but it can have a very significant downside. And at the end of the day, this is too risky of a stock for me to invest in for that reason. I would think this would have very good short-term growth, especially as we continue to quarantine here. A lot of people watching Netflix and catching up on their documentaries and Tiger King, all that good stuff that they have in terms of content right now. But if it hits any rough patches, perhaps when quarantine is over, people look to other sources for content, and perhaps Netflix, in terms of the shows that are on there, we've saturated somewhat. We've seen the shows that we want to see, and we're looking to other sources of media once it comes back to time. So that's a big risk that I see for Netflix. So for that reason, lots of volatility and big significant differences between the intrinsic value approach. So from a corporate overview perspective, if we look at the positives, has excellent viewership and subscribership has increased, especially during COVID-19. Provided that it can borrow the money, low interest rates as we get into periods of quantitative easing and trying to stimulate the economy, Netflix benefits from this. So they're borrowing a lot of money to try to finance purchasing content, developing new content, and they say in their annual report that the interest rates and debt values that they have are really influenced by these values. So if the interest rates are low, this will help Netflix at the end of the day. And we're seeing growth rate of their subscribers year over year, which is positive for the company. And obviously their investments in content are attracting new clients year over year. From a negative perspective, I have a tough time with this market cap. So if you look at Netflix, generally they're content focused, and that's really what they have in terms of their books. Their market cap exceeds Disney by $6 billion. So when I look at what Disney has in terms of parks, in terms of content that they own, I really struggle with the fact that Netflix exceeds their market cap. And I think that's a big red flag when you're doing comparisons for its peers. So with that alone, I would stay away from Netflix. And I know we've done a value investment look into Disney, and I strongly encourage you to check that out. It's on our YouTube channel here, and I think Disney's a good value pick, but Netflix, with the market cap it has, is just way too overvalued. The content filming at the moment is largely halted, and they talk about this in one of their quarterly updates. This is probably likely a short-term impact, but we may see that drop in viewership as people tend to saturate the content they're viewing. Netflix largely doesn't own content when you compare it to Disney Plus, who has a catalog of historical content. They need to develop this, or they need to purchase these licenses, and that's why they have such high levels of debt. And individuals may transition to other sources of media post-COVID-19. And I think the main challenger that they have is with live content. So as sports comes back online, game shows, reality TV, things that maybe they could turn around a little bit faster than developing a new series on Netflix. I think this could be a hit to their subscribership, and we may see some drops in levels. So I would be concerned when we come out of this and other stocks start to boom that maybe we'll see some dips in Netflix, and ultimately subscribers may drop off as well. So again, in summary, when we look at the growth rate we have, it has fantastic growth rate, but just with the cash flows it has, the debt levels it has, to me, it has potentially tremendous upside, but also really, really tremendous downside. And as a value investor, I do not have Netflix in my portfolio for that reason. And as mentioned, I would be worried about the value of this stock and what it trades at after we get out of this coronavirus concern and potentially subscribership does drop off. Thanks for tuning into this episode of Invest You. Please click subscribe below. And shoot us an email at valueinvestu@gmail.com, and we'll send you a copy of our stock analysis program, which helps perform similar analysis on tickers of your choice.